All right, the last one we're going to look at the stocks category, and we've got 401k, and we've just got the basic stock market. Okay, these are your ultimate high risk, high reward options. Okay, especially this one right here. This is you're going all in. You're going to either make a lot or you're going to lose a lot. And we're talking like big time rates here. Okay, you could lose all your money, or if your stock doubles or triples, you can make 200, 300%, which is enormously bigger than these. Okay, but you could also lose everything you have. Over here, as far as risk reward goes, still going to be a fairly high risk. Okay, but the one difference between these two things we're going to point out, this risk is not going to be quite as high because usually when you invest in a 401k, it's a lot of stocks put together in something that's usually called a mutual fund. Okay, here you're basically buying one or two stocks. You're saying this company or this company. This you might be investing in thousands of companies at the same time. So if you think about it, if one of your companies over here and you only have a few tanks, you're going to lose a lot of money. If one of your company's tanks here, you've got a lot to fall back on. So that's something to keep in mind when differentiating between these two. But definitely these are going to be high risk, high reward. These are what we would call a long-term investment, for sure. If you're looking to retire, this is a really big time long-term investment. Okay. Now, stock market's probably going to be a long-term investment because you're probably going to think down the road. You're probably going to buy and sell. You're probably thinking of the future. But this could end up being a very good short-term solution. If you think about it this way. Let's say I buy a stock, and I buy, $2,000 worth of stock, and my stock triples in value. Now I've got $6,000. I might want to just take that money out right away and keep it, the $6,000. And you can do that because they're your stock. Because if you keep it any longer, you risk that $6,000 going back down where you started and then possibly even losing more. So if you make a big score here in the stock market, usually you're just going to take the money out and you're going to keep it. So this is kind of a mixed bag. This is basically all long term. 401k is basically all long term. Where the stock market, it just depends. If you get a big score, you might pull it out and it's going to be short term. Otherwise, you might want to keep your stocks going for the long term. This might be a retirement option for you. Taxes. Here's the difference between the two. Stock market, anything you make, you're going to have to pay taxes on them for sure. 401k is a really special deal. Any money you make, you do not have to pay taxes on. And this is huge because if you make a ton of money off of this, which you can because it's pretty high reward, you are going to be left with a lot of money. Over here, if you make $200,000, you might have to give $50,000 back to the government for taxes. Over here, if you make $200,000, that is your $200,000 and you get to keep the whole thing. So that is pretty sweet. Available. Stock market, it's your thing. You can take it out whenever you want to. 401k is a little different. 401k, if you want to take money out of your 401k, you're going to have to pay some kind of a penalty for it. So please keep that in mind. Interest rates. We're talking big interest rates for this and very, very varied. Stock market for sure. You could have, and I remember when we're going to do this later this year, we'll do a stock market deal, but I remember with one of my other 8th grade classes, we had, we bought and sold some stocks on an online thing, and one person bought some Nike stock. And in that one day alone, it went up 20% and it went down 60%. Varied big time here. Over here, it's definitely going to be varied, just not as much because you have so many other, you're investing in so many other things here, not really single things, a lot of things. But it's definitely going to be varied here as well. Other things to keep in mind, and this is typical. Usually stock market, you're doing your own thing. Okay? You're buying, you're selling. Over here, you're usually, hiring somebody. You're working with a group or you're working with a consultant to help you out here. Okay? And there's good and bad to both of these. Here, you don't have to pay a consultant to help you, but you may not have very much knowledge about the stock market. Over here, you have to give the consultant a certain percentage of the money that you put in. On the flip side, you're hoping that they're going to be pretty smart and they've been doing this for years, so they're going to make you a lot of money. Back and forth to this, okay? Let's go over this real quick again. This is a lot different than the other two, okay? These are both usually long-term options. This could be a short-term option if you make a lot of money real quick and you want to take it out. Risk reward, high risk, high reward, especially for this one. Let's see, taxes. Yes, you have to pay taxes. No, you do not have to pay taxes when you're done. Availability. This is yours. You take it out whenever you want to. This is yours, but you cannot take it out whenever you want to. You can, but you'll have to pay some kind of a penalty for it. All these options here are good options given their certain places. Okay? So just keep that in mind. Everything has a positive and a negative to it. And eventually I'm going to give you some scenarios, some situation. I'm going to say, what would be the best scenario for this person? And I'm hoping that by doing this grid, listening to this video, you will have a solid grasp on this.